Okay, markets hitting new highs this week as the US Federal Reserve and the Bank of Canada are, according to observers, poised to cut interest rates tomorrow. Our guest says those rate cuts will continue into next month, driven by weak job data, but inflation and tariffs are key concerns. Sadiq Adatia, Chief Investment Officer at BMO Global Asset Management, joins us now. Great to see you.
Thanks for having me.
So just to get it out of the way, you do anticipate cuts from both banks tomorrow?
I do. I think the data supports cutting rates. I think inflation has been relatively tame. You've got the slightly weaker job reports coming out and the revisions going back as well. I think just let's both central banks do the right thing and cut interest rates.
Record highs for markets once again. Do you get a whiff of over exuberance here?
No, if you look at the all the noise that we've been hearing throughout the year, you would be kind of surprised at how well the markets have done. I think that's a fair statement. But if you look at the underlying fundamentals, I think the markets are where they should be. We've got great earnings numbers. We've seen good participation by consumers. You've seen, though tariffs discussions going on, they haven't been the 50, 60% that people were expecting at the beginning of the year. You get a little bit more clarity coming through. We've got tax cuts potentially down the road and deregulation. So to me, the market has actually moved in the right way based on the underlying fundamentals, as long as you separate the noise.
We have heard an argument that a lot of the gains in U.S. earnings have been driven by this AI investment. It's obviously great for companies if they're selling AI servers and stuff.
Yeah, the AI theme is not going away. There was some talk about that earlier on in the year, but this is not a one-year story or a three-year story. This is going to be decades-long story that continues to evolve over time, and companies are going to need to invest in that, whether it's the high, heavyweight companies or even the smaller companies, because you're going to have to be more efficient. You're going to have to be able to utilize, AI to drive your efficiency, to maybe minimize your cost on the input side, especially people costs. And when you put that all together, right, that means that you're going to continue to see money moving, forward in a lot of these AI-driven companies. And it's not just AI; it's cloud computing, it's robotics, automation. It's all of that that's going to make things move a lot smoother, drive margins higher, and that investment has to continue on, which still gives room for these companies to continue to grow higher and their multiples to expand over time.
I wonder, though, if profits don't come through, will investors get sour on that? Because we have seen that in the past. Remember Meta over the past few years, big investment cycles, investors wondering, will you make money on this?
Yeah, I think that's a great point. I mean, go back to the internet boom, for the, first 5 or 7 years, that was the story. There was a hype for the first couple of years, and then no real earnings coming out of it, and the stocks dropped tremendously. It took another 5 years after that before we actually finally saw the heavyweights that we see today that came out of the internet boom. And so I think the difference here is that the AI cycle is a lot faster. Earnings can be translated a lot quicker. We're seeing some evidence of that already. But to get the full potential, I think you're still a few years out from here. And therefore, I think that you will get every so often investors looking and saying, show me the money off the AI investment. You'll be able to show some productivity, but maybe not as much of the investments tied to the returns that you're expecting. So you'll see pullbacks along the way, but then you'll see some opportunities again popping up, and the market cycle will bounce up. And we've seen that even this year in the AI world as well. But you continue to see spending towards AI, whether it's in the chip sector or levels below that, where I think you're going to see continued growth in the space.
Broadly, you're neutral bonds. You're not making a bet on inflation falling away decisively, for example.
That's exactly right. I mean, we prefer bonds over cash. And last month we were overweight both equities and bonds, which was the right call. But I think at this stage, I think we want to be more neutral on bonds, more optimistic about equity side, and then be underweight on the cash side. I think bonds, we are going to see rate cuts, which should help that. But I think on the inflation side, I'm expecting inflation to go exceptionally low. I'm expecting inflation to go exceptionally high. I think it's going to stay at a steady pace that allows central banks to cut, but not necessarily get too aggressive on the rate cutting cycle.
Now, you're overweight U.S. equities. I think you indicated you do see strength continuing, but you have gone a little underweight Europe, Asia, and the Far East.
Yeah. So if we look at, again, what's happened at the beginning of the year, we were always expecting to see some more diversification in the equity markets. So more buying of international, more buying of Canada, and that's been a great call this year. But again, BMO, what we've been looking at is, do the underlying fundamentals justify the returns we've seen so far? In international space, I don't think so yet. Because when you think about the fundamentals in the earnings story is much better in the US than it is in international markets. On top of that, you don't have just one country like the US, you have multiple countries within Europe. And therefore, there are some countries that are doing much better, but there are some that are lagging behind. A lot of the momentum that we've seen in international markets has been tied to defense spending. Well, that's not going to be able to continue at that pace that we've seen so far. And so we do need to see rate cuts happening there. We need to see a better job picture out there. But there's no doubt that Europe is much better today than it was a year ago. But I think maybe the markets have moved a little too far too fast. And therefore, we're tilting back to the US where we think we're going to see more upside from now to the end of the year.
It is interesting, though, with the weakness in the Canadian dollar, relatively speaking, this year. Broadly, Bloomberg calculates that in blue chip stocks in Europe, they're up about 11%. But if you're a Canadian investor in Loonie terms, you're up just over 20%.
And that's exactly it. Currency is so important to be paying attention to, right? At the beginning of the year, we saw the US dollar depreciate quite a bit against the Canadian dollar. But more recently, we've seen more of a sideways moving market, a little upside of the U.S. dollar. We think the U.S. dollar has had, its downturn for the year and will probably remain relatively steady at this stage. Over the long term, I do expect the U.S. dollar to weaken and the Canadian dollar to appreciate relative to the U.S. Now, that's going to take some time, obviously, and there's still some uncertainty tied to the tariffs and the USMCA deal, because that could also cause a difference between, the currencies as well. So I do think we want to stay neutral right now on the currency side. Earlier in the year, we were more bullish towards the Canadian dollar, but I think we brought it back to more of a neutral side. And that's important because as you invest outside Canada, the currency return has an impact when you bring it back in Canadian dollar terms.
Have you been inclined to underweight Canada with the economic dangers we have?
Yeah, so we had a little bit of underweight earlier in the year. At this stage, I think a lot of that was priced in. I think that the fact that we pulled back on the reciprocal tariffs was a good thing. I think it shows that we're willingness to work with the U.S. I think the bigger story here is going to be the USMCA deal, because today our tariff rate is 6% when you include the USMCA deal that we have in place, and that's lowest from all the other nations out there. But that is heavily dependent on this USMCA deal continuing in the current form, and there's no guarantee that's going to occur. So for the next 6 months, I think our focus has to be on making sure that we get the best deal possible out of that. It likely won't be the same as we've seen it today. That will probably push tariffs a little higher, but hopefully not to levels that we see in other parts of the world.
Sadiq Adatia, thank you very much indeed. Sadiq is Chief Investment Officer at BMO Global Asset Management.